in terms of your earnings, a very strong quarter this time once again. In fact, we're seeing a good amount of improvement in terms of the VNB margin, as well as pretty much a good growth. The share of protection business, in fact, has increased. What has led to this improvement, and is it sustainable?
Well, this continues to present what we have been saying for the longest period of time, that we are driving a very balanced business model. As part of that balanced business model, from a product mix perspective, we've always said that we want to increase our share of protection to more than where it is. Last year, if you recall, our numbers on a received premium basis are 27%, which was a multiple, 4 to 5 times multiple of what the second player, we believe, recorded. This quarter just continues to demonstrate a continued build-up on that strategy. So if you were to compare the numbers across 2 quarters, it was about, on a WRP basis, 13%, gone up to 18%. And obviously that leads to an uplift in our margins, one of the factors of leading to better margins. But it's not just that. If you look at some of the other matrices also, in terms of growth in comparison to the industry, if you look at our persistency numbers, return on equity or embedded value, if you look at the number of lives we have assured, which is more than 1 crore this quarter, or the number of new relationships we have added, I think we just continue to build on the foundation which we have, as a strategy laid down 5 to 7 years back, and the execution has been pretty solid in this quarter.
Right.
And we are hoping that we will continue to execute in some of these new areas. Will continue to do very well. One of the things I want to point out is that if you look at our annuity business, it has grown 315%. I mean, that has again been a part of the strategy which we've been working on for the last couple of years. So numbers don't happen suddenly; they happen as part of a strategy, and I think as the strategy starts playing out, suddenly you do see a spurt in numbers which people have not seen. Now, as people have copied us on some of our strategies in the past, I'm sure you will see people following us in these areas also.
All right. Vibha, what explains the kind of improvement in the embedded value? We've seen a good amount of improvement there, nearly around 19% growth at 15,700 odd crore. But at the same time, although the operating return on embedded value is healthy at 18%, I'm seeing some amount of decline both on a YOY basis and quarter on quarter. Could you please explain that?
Yeah. So the decline from 22% that you mentioned to the 18.2% is because the 22% was included a reversal of some of our reserves that were there, that we were holding. This was against the backdrop of our IPO, when we got an external actuary to look at our numbers and validate them. So there was a bit of a conservatism, which under the actuarial standards, APS 10, we had to reverse them. Right. So the normalized number against that would have been 17.2%, and so it's very much in line with the 18 odd % that we have been tracking year on year. And some of the contributors to this kind of an increase and steady growth in our embedded value, ending at 18,000, close to 18,700, was one is the unwind rate has been healthy. Right. Also, you'll see positive operating variances. Our margin itself, which is the 24.2%, which has added to the embedded value growth, and this is despite having quite a volatile operating environment that we've been able to end at this kind of a growth in embedded value.
Right. Amitabh, if I'm looking at the overall market share gains, well, market share still is fairly good at somewhere around 22 odd % there within the entire private sector. What would be your strategy going ahead for the next 2 years? And I know that we were looking at Max Life again, but any other inorganic growth plans coming over the next 2 years?
I just want to clarify, you said Max Life again. We have not made any statement to the effect that we're looking at Max Life. Yes, we have said that we'll continue to evaluate any acquisition opportunities which might come around, and if they can add to our franchise, we'll very actively look at it. Today we have a currency to be able to, kind of literally acquire any company of any large size in the sector. But you have to be a bit apprehensive also. I mean, if you look at all the transactions that have been attempted in the life insurance space, including the latest one,
right,
IDBI Federal, none seems to get fructified. I think the general insurance industry has had more luck than us. But yes, as far as the growth rate is concerned, we obviously, if you want to be a market leader, it is important that you grow faster than the industry and continue to record a good growth. But we don't want to hinge our entire strategy on just delivering growth. Our growth has to be profitable. Our growth has to kind of be very clearly linked to our overall strategy, and only then we will go for growth. We are quite clear in our minds that we need to have products which are innovative, which satisfy a particular customer need, and our products should be competitive with all the other financial asset classes. So yes, we were the first ones to bring kind of really go after the online space. We're the first ones to come out with the cancer care product. We're the first ones to come out with the combo product. We are the ones who launched the deferred annuity product in India for the first time, and we can expect that kind of innovation to continue to come from us going forward in the future. So our strategy is obviously all long term. I mean, you know, even if you look at what we've done in the retirement space, it has been a strategy which has been, you know, in the works for the last 3-4 years. And we continue to ask ourselves the question as to how the market would look like, you know, 3 to 5 years down the line, and what we need to do today to be able to capitalize on that opportunity as and when it comes about.
So just taking that point further, how do you in fact look at the market growing? What are the key trends that you're observing over the next 2 to 3 years, and how would you be in fact capitalizing on those trends?
So we have said that we expect the industry to grow anywhere between 15 to 18% year on year. Now, year number could change, but on the kind of, if you look at a 3 to 5 year horizon, I think the industry has elements in place to be able to deliver that kind of growth going forward. So if industry grows at that rate, we believe we have the platform to grow at a pace faster than that.
Right.
And that's what kind of we've been working towards. And we believe that kind of platform and some of the various businesses which you have entered into and the market share we're gaining in them, it should be possible to deliver that kind of growth. And that is evidenced by the number of acquisitions we have had on the client side.
Right.
We have now more than 180 relationships across our various bank insurance, NBFC, small finance banks, MFI partners, and new ecosystems. It's a very, very large number. If you look at our competitors, they might be, you know, I'll struggle to give you a number which is 1/4 of what we have.
Right.
Over and above that, recently, and we're going to announce it formally very soon, we have signed up with a very large PSU bank which went through a full bidding process and actually selected us. Just goes to show the power of our franchise and our acquisition engine. So
Right.
we are quite hopeful going forward in the future.
All right. Vibha, we are seeing good amount of improvement in quite a few operating metrics, especially reduction in the expense ratio. Persistency is still showing mixed trends. In some of the segments, we are seeing good amount of improvement. For example, the 13-month persistency has improved, but the larger tenure over 60-month persistency, some amount of decline. There's some mixed trends there. What is the kind of further improvement are you seeing in the key operating metrics for you?
So on the expense ratio, for the first time we have put out also the waterfall on the expense ratio to show the reduction in our fixed costs. So the 100 basis points reduction that you've seen, and it has entirely come from reduction in fixed costs, and to bring out the point that our variable cost is also under control, because a lot of analysts have been writing about the fact that in credit protect, for example, there is going to be a lot of competition, or in the individual protection, and to bring home the point that we do manage to eke out efficiencies out of our fixed cost to be able to fund whatever we need to invest in new partnerships, etc. So that trend should continue. And you know, just a last point on that is, whatever costs that you see are fully market priced costs that you see. There is nothing that is either a sweetheart deal with any distributor, or because of some group relationships, or also because of some payments that are made outside the company. So we need to fund our own growth. That is point one. On the persistency, you mentioned some of the negative trends. That's largely in our 61st month persistency. And like I've mentioned in the past also, that this is because of one particular cohort which is now exiting our system, and that cohort, when it had its 13-month persistency, it was 69%, and that's why the kind of numbers that you see at 50%. So that should start inching up closer to the range of about 55 odd percent, and those are the kind of trends that we see of the policies that are currently at the end of their 4th year and would end up at the 61st month in a year's time. So all these kind of efficiencies, to your question, you should see that as continuing to happen, because we have special initiatives that we are running. I don't want to put out a number, but rest assured that we are driving those initiatives to cut out wastage, to see where we can have efficiencies, where we can have the power of our brand to be able to eke out better deals from whether it's our vendors, whether other partners, etc. So you will find that, but not necessarily falling to the bottom line, because we do need to invest in business also. Investments in new partnerships, the 165 partnerships that we ended in the traditional business, on all our traditional distributors, means that we need to be able to invest in brand visibility in terms of engaging with them, feet on street, on technology, all the things that we, and Amitabh mentioned this on the investor call as well, on the technology, so that also requires investment.
Right.
So but this is to be able to fuel our growth.
Okay, all right. One last question to you, Amitabh. We're seeing a deal that's brewing in almost to be completed, which is LIC IDBI Bank. How do you see it really? What does it actually in fact mean for the insurance industry? Would it really change the landscape of the insurance industry that much? And besides just the insurance industry, what would be your view in terms of this entire merger from a larger financial services space?
So firstly, the deal still needs to pan out, because we keep hearing different reports in terms of what LIC's position would be as far as this acquisition is concerned. Will they be a large financial investor and over a period of time they need to reduce their stake, or there will be a period for which they will have management control and then over a period of time they'll give up their stake. So let's wait for the dust to clear on that point. But as far as we are concerned, obviously LIC is seen as someone which can invest this kind of money. LIC has been a very large bank insurance player. Almost every public sector bank has a relationship, in almost all cases exclusive relationship as a corporate agent. So as I think LIC, if they go for a management control or take a large stake, we do hope that some of the public sector banks will go for open architecture and will give an opportunity to the private sector players to also hopefully gain an entry into some of the public sector players, because they might see LIC as a competitor. So let's see how it pans out. I think it's very, very early days. The deal is yet to be consummated, and for form share it is consummated, let's say, is to be seen. But LIC has a huge firepower in terms of the AUMs they have, and government has, and I guess maybe LIC is also seeing it as an investment where they can make money by deploying a lot of capital. But let's wait and watch, and let's see how it pans out.
Okay, how are you in fact seeing the overall competition landscape shaping up over the next 2 years, and how would you be in fact growing within this entire industry in terms of market share?
So I mean, competition intensity in India in almost every industry is quite high. India is not an easy place to make money, but at the same time, if you can gain a certain size and a scale, it allows you the opportunity to invest for the future and capitalize on new opportunities as emerge. So it's ultimately, it all boils down to how well you're executing on what you have decided to do, and not get worried about short-term losses or gains you might have.
Right.
I think HDFC Life has been very, very focused on ensuring that we are playing a very long-term game here, and I think it has stood us very well through these 7-10 years. It is reflected in our market cap and the share price we have. And as a management team, we are very clear we need to continue to be very focused on what we are going to do for the long term and what we are not going to do for the short term. So I think as long as we can be focused on that, we do believe we can continue to deliver solid results going forward.